Hi everyone, welcome to the channel. Today our focus is going to be on two high-end fashion companies. First, Louis Vuitton, which I know a little about as I purchased a few of these LV monogram logo products for my wife, and the other being Hermes. Not sure if I'm pronouncing it correctly, but that's what I'm going with. In this video, we'll look at their financials and perform a stock valuation for each and compare it against their current stock price to see if there's any value opportunities. But first, we'll take a quick look at my portfolio's performance, so let's jump right into it. Here's my portfolio's performance for today, February 27th. And you can see the one that's highlighted, AAP, Advanced Auto Parts, up 7.3% for the day. So I'm not sure why it's up that much, but I did do a video on this several months back when I first bought into the stock. I felt it was undervalued, and it's up about 30%. So far, it's exceeded my expectations in the few months that I owned it. So that's worked out very well. Another position to point out is Google. It's relatively new. I probably bought into it about a week or two ago, and I did a video on it, so you can check it out. Though it's up for today, it was down about 5% yesterday, and I bought some additional shares when that happened. But the reason why it's down is because they got some negative publicity on their AI technology, Gemini, producing woke images when queued for responses. So I just hope people at Google, I know they're smart, just use common sense and just build a technology to give the right answer. And that's all people are looking for. One other position, point out, it's up just over 4%. Palantir, again, I just did a video on that one too. It's a position I've owned for several years, and it's been paying off. Though I do think it's trading at a pretty high premium, but I'm holding. I'm not buying. If the stock drops below 20, I think I said if it gets to about 18, I'll buy more shares. Right now, it's probably trading around $24, $25. But up today, 4%, not complaining. We're going to jump to another slide just to show the overall returns on these positions. So here's the portfolio's performance overall. We can see Google there down slightly, though as I mentioned, I've only owned it for a couple weeks now. But I am optimistic for the next 1, 2, 3 years on Google. I'm sure I'll make some good money based on the price I bought in at. But for holding it for a longer term position, they really need to straighten out their Gemini AI platform and just giving people the right answers. Because I like holding companies for the long term, like Palantir. I've owned that for over 3 years. Patrick, PATK, same thing. I probably owned that for about 3 years as well. Though some of these are relatively newer, like URI, United Rentals. I bought that several weeks ago, maybe a month and a half ago now. Uh, Tesla, again, I bought that probably a couple weeks ago, and I done videos on all these. But I like finding companies I feel are undervalued, buying in over time when I feel the stock price drops, because I like holding for the long term. But let's move on and look at Louis Vuitton's financials. Looking at Louis Vuitton's financials, you can see at the top the overall summary. Everything's checked off, meaning everything's pointing in the right direction. So if you're not interested in going through all the data points, you can move on to the next segment where we do the stock valuation. But if you want to spend a few minutes, I'll walk through the data points here. And first one, dividends. We can see dividends growing over time, and that's what I want to see in a company that pay dividends, that it is increasing. And over the last 10 years, it's up almost 250%. So like to see that. And then shares. Now, I like seeing companies buying back shares, and we can see Louis Vuitton has done that, but it's only down about 1%. So it's not a dramatic reduction, but still it is down. It's not increasing. So I am giving that a positive sign. And then right below that, we have revenue and revenue per share. Again, increasing over time, what we want to see in these financials, increasing up almost 150% for revenue, and then on a per share basis, up just over 150%. So overall, two nice signs here. All the data points pointing in the right direction. So let's move on to a few other data points. Net income and earnings per share pretty much the same. Since they haven't bought back significant amount of shares, the EPS will pretty much match net income. And we can see it has grown over time. Yeah, they had a dip or two throughout the past 10 years, but up overall, up almost 140%. So this is what we want to see again. Everything increasing, going up and to the right. And then free cash flow and on the per share basis, we can see the last 2 years, it's on a slight decline from 2021, where it was an all-time high. But you can see that was up 70% from 2020. So I think 2021 is probably an anomaly with that big increase. But still, over the last 10 years, from 2014 to 2023, it's still up. It's up 240%. So again, a great sign here for the company, increasing their cash flow. That's what we want to see is all these data points going up and to the right. Then book value per share, same thing, growing over the last 10 years, up over 140%. Then return on invested capital and net profit margin, I like seeing both of these over 10%. And for return on invested capital, we can see it's typically over 13%, 14%. Yeah, they had 2 years that were slightly under 10%, but last 3 years, it's increasing. So a great sign there. And then for the net profit margin, over 10% for every year, and the last several years, over 15%. So again, great data points. And then long-term debt to free cash flow, I like to see this under 3. We can see they're well under 3, actually under 1. So they have no problems with their debt. They can probably pay it off if they had to. So as I said in the beginning, overall great financial signs for Louis Vuitton. But let's move on now and perform the stock valuation. Here's the valuation for Louis Vuitton, and we see intrinsic value at $139.82, and with a 90% margin of safety, brings it down to $125.84. Now, this is based on a 14% short-term growth rate over the next 10 years with a 10% discount rate and a 4% long-term growth rate. Now, up here in the top right, we can see the net income and earnings per share CAGR for each of them have been just over 10%. Now, I am using that 14% short-term growth rate. However, because the free cash flow and revenue growth has been at that 14% level, and Louis Vuitton typically trades at a premium. So if I want to buy into the stock, I kind of have to look at justifying a higher growth rate. And I can do that, like I said, looking at their history for the revenue growth and free cash flow. Now, the stock is currently trading at around $183, which gives them just under a 28 PE ratio. So, yes, it is a little on the higher side and probably a little higher than I would pay for a stock. But let's look at what the short-term growth rate the market's using to value it at $183. So we're going to change that 14% and let's just jump that up to 18%, see how it changes. So we see with that 18% short-term growth rate, intrinsic value jumps up to $193.75. So a little higher than what the market currently is valuing the company. So let's just bring that down to 17%. And with a 17% short-term growth rate, the intrinsic value comes to $178.61. So the market's probably valuing the company more around a 17.5% short-term growth rate to get to that $183 valuation it's currently at. But let's move on now and we'll look at Hermes Financials and perform a valuation for that company. Looking at Hermes Financials, we can see the summary at the top. Everything's heading in the right direction. That's why we have all the check marks. So again, if you want to just move on to the valuation, you can jump to the next section, or you can take a few minutes as I walk through the data points here. And the first one, we see dividends grown over the last 10 years, actually grown significantly over the last 2 years, up 65% for each year, and up more than 320% over the last 10 years. So a great sign there. As I said before, a company that pays dividends, I like seeing that growing over time. And then for shares, so really no movement in shares. Actually, it hasn't grown or decreased over the last 10 years. So I am giving it a check because they have not been diluting shareholders. So that is a good sign. And then we have revenue and revenue per share, both of them growing just under 190% over the last 10 years, which would be about a CAGR of 12.5%. So right here, good signs, nice growth here for revenue. But let's jump down, look at a few more data points. The net income and earnings per share, each of these up more than 340%, which would be about a CAGR of 18%. And we can see for the 3 most recent years, 2021 up 64%, 2022 at 29%, and for 23 up almost 32%. So significant growth there for the company. But even more impressive now is the free cash flow and on a per share basis. And these are up almost 430%, which would be a CAGR of just over 20%. So even more growth here coming in for the company in terms of their cash. And same thing, we can see these last 3 years almost up 100% in 2021. 2022 up 15%, and in 23 up 6.5%. Now, when we looked at Louis Vuitton, we've seen for the last couple of years, it was actually on the slight decline. But for Hermes's case, they're expanding on that free cash flow growth. So very good sign here for the company. Well, let's go down and look at a few other data points. And their book value per share up almost 290% over the last 10 years. So we see this growth continuing across the board. And then, as I mentioned earlier, return on invested capital and net profit margin, I like to see 10% or higher. And we can see for return on invested capital, they're way above that. They're actually above 17%. And really, for most of the years, they're up over 20%, except for in 2020. So very good sign there. Return on invested capital is a very important metrics for a investor. So really like to see that. And net profit margin, we see up over 20%, really up over 21%. So a great sign there. This company's making money. And then long-term debt to free cash flow, as I mentioned earlier, I like to see under 3, and they're well under that. They're basically at 0. We can see 0.01. So they basically have no debt, and whatever they do have, they can easily pay that off. But let's move on now, and we'll perform the stock valuation for the company. So the valuation for Hermes, we are going to make a modification in a few minutes, but what we have right now is intrinsic value of $121.67. And again, with a 90% margin of safety, brings it down to $109.50. Now, this is based on an 18% short-term growth rate over the next 10 years with a 10% discount rate with that same 4% long-term growth rate that we had for Louis Vuitton. Now, I'm using the 18% initially here because we see here the net income CAGR and earnings per share, both 18%. Now, same thing. I know Hermes is a premium brand, usually trades at a higher valuation. So I'm willing to go up to like a 20% short-term growth rate. So let's just see what the new valuation comes to. So that 20% short-term growth rate increases the intrinsic value up to $143. And now the stock is currently trading around $250, which gives that like a 50 PE or just over a 50 PE. So trading at a pretty high premium. Now, I'm not willing to go up that high for a stock, but let's just see what the market is using as a growth rate to give it this $250 valuation. So we're going to change that 20% short-term growth rate to 25. So 25% short-term growth rate increases it to just under $214. So not quite at that 250. So let's just raise that to a 27%. So with a 27% short-term growth rate, we can see intrinsic value just over $250. So basically where it's currently trading, and that's a pretty high premium for at least I believe for a company like this to believe it's going to grow 27% a year for the next 10 years. That's like a high-tech company or a growth company growth rate. And I just don't see it. And with a PE of 50 or just over 50, that's a pretty high premium to get into this stock. Now, I know it usually trades at a high valuation, but as a value investor, that's way too much, I believe, to pay. But let's compare the stock movement for both these companies over the past several years just to get an idea on how the returns have been. Here's the performance for each of the stock over the past year. We can see Louis Vuitton in blue and Hermes in green. And Louis Vuitton up 11.4%, while Hermes up almost 40%. So Louis Vuitton falling behind on the 1 year. And actually, for all these years we're going to look at, the 2 year, again, Louis Vuitton up just over 21%. Hermes up 77%. 5 years, same thing. So that's probably why you're paying that premium for Hermes. Much better returns in their stock price, though very high, paying that high premium. PE of 50 or just over 50. So you really got to believe that they can keep up these returns and the stock price will continue to increase like this. But for me, it's not the type of investor I am. And if I had to pick, I'd probably just pick Louis Vuitton just because I feel it's valued more appropriately, though it's still higher than what I would normally buy in. And I'm probably not going to buy into either one of these stocks, though it doesn't mean you can't make money. Just depends what type of investor you are. And these are not the type of stocks I normally buy into. But I hope you enjoyed this video, got some useful information. If so, consider subscribing, and I hope to see you next time. Thanks for watching.